Imagine waking up one morning and the price of everything has doubled. Your morning coffee, your favorite cereal, even your go-to brand of instant ramen, all twice the price. This might sound like a scene from a dystopian movie, but it's a simplified illustration of how changes in interest rates, particularly those set by the US Federal Reserve, can impact your wallet. Now, before you start hoarding ramen noodles, let's break down what the Federal Reserve is, and why their decisions matter to you, even if you don't live in the United States. The reality is that we live in a deeply interconnected global economy. What happens in one corner of the world, especially in a powerful economy like the United States, can send ripples across the globe, affecting everything from the price of your groceries to the value of your savings. So buckle up, because we're about to take a crash course in global economics. The Federal Reserve, often called the Fed, is like the central bank of the United States. Think of it as the big kahuna of American money. One of the Fed's main jobs is to set interest rates. Interest rates are like the cost of borrowing money. When the Fed raises interest rates, it becomes more expensive for everyone, individuals, businesses, even governments, to borrow money. Why does this matter to you? Because when interest rates in the US go up, it creates a ripple effect that can be felt around the world. Imagine the US economy as a giant swimming pool. When the Fed makes a splash, everyone gets a little wet, not just the folks swimming in the deep end. This is where things get interesting, and a little complicated. Countries with strong economic ties to the US, like India for example, often feel the effects of the Fed's decisions more acutely. But before we dive into the specifics of how India is affected, let's take a broader look at how interest rate changes impact the global economy. One of the main reasons the Fed raises interest rates is to combat inflation. Inflation, in simple terms, is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. Inflation is when prices for goods and services increase over time. This means that the same amount of money buys fewer goods and services than it did before. For example, if the inflation rate is 2%, a $1 pack of gum will cost $1.02 next year. While this might not seem like much, over time, inflation can significantly erode the purchasing power of your money. Remember our doubled grocery prices? That's inflation in action. When inflation is high, it can lead to uncertainty in the economy. People might start to expect that prices will continue to rise, which can lead to even more inflation as businesses raise prices in anticipation of higher costs, and workers demand higher wages to keep up with the rising cost of living. When interest rates are low, borrowing money is cheap. This means that people and businesses are more likely to take out loans to buy homes, cars, and other big-ticket items, or to invest in new projects and expand their operations. This increased spending can help to stimulate the economy, leading to more jobs and higher wages. This encourages people to spend more, which can lead to inflation. When people have more money to spend, demand for goods and services increases. If the supply of those goods and services doesn't keep up with the increased demand, prices will rise. This is why central banks, like the Fed, have to be careful about keeping interest rates too low for too long. By raising interest rates, the Fed tries to cool down the economy and keep inflation in check. Higher interest rates make borrowing more expensive, which can reduce spending and investment. This can help to slow down the economy and reduce inflationary pressures. However, this is a delicate balancing act, as raising rates too much or too quickly can also have negative effects. But here's the catch: higher interest rates can also slow down economic growth. When borrowing costs are high, businesses may be less likely to take out loans to invest in new projects or expand their operations. This can lead to slower job growth and lower wages, which can reduce consumer spending and further slow down the economy. This is because businesses may be less likely to borrow money and invest in new projects when borrowing costs are high. Additionally, consumers may also cut back on spending if they have to pay more in interest on their credit cards, mortgages, and other loans. This can lead to a decrease in demand for goods and services, which can further slow down economic growth. It's a delicate balancing act, and the Fed's decisions have far-reaching consequences. The goal is to find the right balance between keeping inflation in check and supporting economic growth. This is not an easy task, as the economy is influenced by many factors, including global events, technological changes, and shifts in consumer behavior. So, how does this all tie back to our globalized world? In today's interconnected global economy, the actions of one country's central bank can have ripple effects around the world. For example, when the Fed raises interest rates, it can attract foreign investors looking for higher returns on their investments. This can lead to an increase in the value of the US dollar relative to other currencies. Well, when the Fed raises interest rates, it can make it more expensive for other countries, especially those with a lot of debt in US dollars, to repay their loans. This is because a stronger US dollar means that it takes more of their own currency to buy the same amount of dollars. This can lead to higher debt servicing costs and put pressure on their economies. This can lead to economic instability in those countries, which can then spill over into the global economy as a whole. For example, if a country is unable to repay its debts, it might default, leading to a financial crisis that can spread to other countries. This interconnectedness means that the Fed's decisions can have far-reaching consequences beyond the US economy. It's a complicated web of interconnectedness. The global economy is like a finely tuned machine, with each part affecting the others. Central banks, like the Fed, play a crucial role in maintaining the stability of this system. Their decisions on interest rates can influence everything from the cost of borrowing to the value of currencies, and even the stability of entire economies. Understanding this delicate balancing act is key to understanding the broader economic landscape. Section 4. India and the Fed, a tale of two economies. Let's bring this back to India. India has a large and growing economy, and it has close ties to the United States. The relationship between these two nations is multifaceted, encompassing trade, investment, and geopolitical strategies. Over the years, the economic ties have only strengthened, making the dynamics between the US Federal Reserve's policies and India's economic health even more significant. When the Fed raises interest rates, it can have a significant impact on India in a few different ways. The Federal Reserve, often referred to as the Fed, is the central banking system of the United States. Its decisions on interest rates are closely watched by economies around the world, including India. The ripple effects of these decisions can be profound and multifaceted. First, it can make it more expensive for Indian companies to borrow money from abroad. Many Indian businesses rely on international loans to fund their operations and expansion plans. When the Fed increases interest rates, the cost of borrowing in US dollars rises, making it more challenging for these companies to secure affordable financing. This is because many Indian companies borrow in US dollars. The preference for dollar-denominated loans stems from the stability and global acceptance of the US dollar. However, this also means that any fluctuations in the dollar's value or US interest rates can directly impact the financial health of these companies. When the dollar strengthens, as it often does when US interest rates rise, it takes more rupees to repay those dollar-denominated loans. This can strain the finances of Indian companies, leading to higher costs and potentially reduced profitability. The exchange rate between the Indian Rupee and the US dollar becomes a critical factor in this equation. Second, higher US interest rates can make it more attractive for investors to pull their money out of emerging markets like India and invest it in the US instead. This phenomenon, known as capital flight, can lead to reduced investment in Indian markets, affecting everything from stock prices to infrastructure projects. This is because investors are always looking for the best return on their investment, and higher interest rates in the US can mean higher potential returns. The allure of safer, higher-yielding investments in the US can draw capital away from riskier emerging markets, leading to volatility and uncertainty in those markets. Finally, changes in the US economy, such as a slowdown in growth caused by higher interest rates, can also impact demand for Indian exports. The US is a major consumer of Indian goods, ranging from textiles to technology. Any reduction in US consumer spending or industrial demand can have a direct impact on Indian exporters. The US is one of India's largest trading partners, so any slowdown in the US economy can have a ripple effect on India's export sector. This interconnectedness means that Indian businesses must stay attuned to economic developments in the US and be prepared to adapt to changing conditions. The tale of these two economies is a complex narrative of interdependence and mutual influence, highlighting the global nature of modern economic relationships. Section 5. The mighty dollar. A blessing and a curse. The US dollar plays a unique role in the global economy. It is not just a piece of paper or a digital number, it is a symbol of economic power and stability. The influence of the US dollar extends far beyond the borders of the United States, affecting economies and lives around the globe. It's the world's reserve currency, which means it's held by central banks around the world as a safe and stable asset. This status as the reserve currency gives the US dollar a unique position in international finance. Central banks from Europe to Asia hold vast amounts of US dollars in their reserves, using it as a benchmark for their own currencies. This widespread use of the dollar helps to stabilize the global financial system, providing a common ground for international trade and investment. This gives the US a lot of economic clout, but it also means that the Fed's decisions have a disproportionate impact on the global economy. When the Federal Reserve adjusts interest rates or implements monetary policies, the ripple effects are felt worldwide. A decision made in Washington can influence stock markets in Tokyo, real estate prices in London, and commodity prices in Brazil. This interconnectedness underscores the importance of the US dollar in maintaining global economic stability. When the US dollar strengthens, it can make US exports more expensive and less competitive on the global market. American products from agricultural goods to high-tech equipment become pricier for foreign buyers. This can lead to a decrease in demand for US exports, affecting industries and workers who rely on international sales. The strength of the dollar can thus have a direct impact on the livelihoods of many Americans. This can hurt US businesses that rely on exports. Small and medium-sized enterprises in particular may struggle to compete with cheaper foreign alternatives. Factories may see a decline in orders, leading to potential layoffs and closures. The ripple effect can extend to local communities where businesses and workers depend on the success of export-driven industries. However, a strong dollar can also be a good thing for American consumers. It increases their purchasing power, allowing them to buy more for less. Imported goods from electronics to clothing become more affordable. This can lead to a higher standard of living as families can stretch their budgets further and enjoy a wider variety of products. It can make imported goods cheaper, which can help to lower inflation. When the cost of imported raw materials and finished products decreases, it can lead to lower prices for consumers. This can be particularly beneficial during times of economic uncertainty, helping to keep inflation in check and maintain the purchasing power of the average American. It can also make it cheaper for Americans to travel abroad. A strong dollar means that American tourists get more value for their money when visiting foreign countries. This can lead to a boost in international travel, as more families and individuals can afford to explore new destinations. The benefits of a strong dollar extend beyond shopping and travel, influencing various aspects of daily life. So, the impact of a stronger US dollar is a bit of a mixed bag. While it can provide significant advantages for consumers and travelers, it can pose challenges for exporters and businesses that compete in the global market. The dual nature of the dollar's strength highlights the complexity of economic policies and their far-reaching effects. It can be good for some and bad for others, both within the US and around the world. The global economy is a delicate balance, and the US dollar plays a crucial role in maintaining that equilibrium. Understanding the multifaceted impact of the dollar's strength is essential for policymakers, businesses, and individuals alike. Understanding the role of the US dollar is key to understanding the global impact of the Fed's decisions. The decisions made by the Federal Reserve are not just about managing the US economy, they have profound implications for the entire world. By grasping the significance of the US dollar, we can better appreciate the interconnectedness of our global financial system and the importance of thoughtful economic policies.